Thanks, everyone, the few, the proud, the future-proofers on day 3. So good to be here. Delighted to be hosting this panel. We're going to be talking about generational investing, expectations, aspirations, what we're looking for. I got a great panel. Callie Cox, come on out, from eToro, Liz Young from SoFi, Rich Aneser from InvestNet, and Liz Koehler from BlackRock. Come on out, folks. Give these people a hand. We got up early. We got dressed up.
Oh.
Woo! Thank you all. Thanks so much. I just gave this question to the panel right before we got on, so cold answers here, and I'm excited to know, because we're talking about generations, because we're talking about expectations, because we're talking about who people are at different life stages, I gotta know your Desert Island album. Let's start with you on the end, Liz. If you're a castaway with Tom Hanks or by yourself, what's the album you're taking that defines you?
I'm doing Counting Crows, August and Everything After.
Very good.
Bruce Springsteen, E Street Band, Wild and Innocent, E Street Shuffle.
I don't know if this defines me, but the generation, Alanis Morissette, Jagged Little Pill.
Oh yeah, oh yeah, oh yeah.
Yeah, this might be a little atypical for a young millennial, but Sam's Town by the Killers, and this is more typical, Taylor Swift album, Folklore.
Give it up for T Swift. All right, very good answers. That kind of level sets us on who we are and where we come from, but let's talk about investors in different generational levels here. And let's talk about young investors, starting with you, because at eToro, you have a lot of millennials. I think it's 46%. You survey them. You got great data on them. You're talking to them all the time. What are their expectations? Do they feel like they're a part of the process in terms of investing, wealth building, financial services?
Yeah, that's a great question. And Caleb, you're exactly right. We have a very young investor base. In fact, 55% of our customers are either millennial or Gen Z. Over half, I mean, if you do the math. And they're just like us. They're investing for long-term wealth. They're trying to build financial independence. In fact, they tell us more and more that they're not just investing for retirement. They want a way out of their lifestyle. They want to be able to build wealth and feel like they have that freedom. And they're trying every avenue possible to get it. So they do feel a little left out. Unsurprisingly, I mean, we do a lot of research and surveys, and fewer and fewer Gen Zs and millennials are looking toward financial advisors, even though they are getting those recommendations from their parents, and they're on the other side of the baby boom wealth transfer. So, I feel encouraged about where we're going, and I feel especially encouraged by how sophisticated younger investors are these days. But I still think that there's a big gap between where they are, what they're using, and that transition period when they get to a point where they need an advisor.
Yeah, so true. Liz, how do they want to be communicated with? How do you talk to them? You went from working at Alexander Hamilton's Bank, right? Bank of New York, and some other older institutions with an older client base, to SoFi, which has a much younger client base in a different life stage. How do they want to be talked to, especially about investing?
Way differently. First of all, I make this joke all the time. SoFi is the 4th company I've worked for. It's the first one that's less than 100 years old. I went from BMO to Baird to the Bank of New York, which was literally the first stock ever traded on the New York Stock Exchange, and SoFi went public 60 days after I joined. So it was like night and day, and the audience changed entirely too. So all the content that I had to put out now had to resonate with our members, who are 63% of them are between the ages of 20 and 40. And as many of you in the audience know, if you're working at a brokerage firm, and some of the more traditional brokerage firms, the average client is somewhere between 58 and 62. So I went from that age group to much, much younger. I think some of the big differences, first of all, is you have to start at a different spot, right? You have to start in a different place. They're interested in stuff that we're interested in, and I'm a geriatric millennial. I'm 41. It's like the tail end. It's about as old as you get. They're still interested. Thanks for the woo. They're still interested in big tech, but they're also interested in disruption, and they're interested in the stuff that's at the forefront of culture, right? Meme stocks and cannabis and all that kind of stuff that's hot in the headlines. So you have to start in a different place, and it's more educational about diversification, but you got to say it fast because their attention spans are very, very tiny, right? You got to say it fast, and you got to say it fun, and that was a big transition for me to make. And you got to say it with pictures, right? You have to illustrate, what does that mean in a picture? Why does this matter, and where do you see the trend change?
Yeah, if anybody out here is under 35, you can actually speed this one up to 1.5 if it's too slow for you. We have that available on the app. So Liz, at where you work at BlackRock, working with advisors on engagement, this is a new sort of battle and a new frontier, but not one they haven't started to solve. But how are you counseling them, and what are your advisors seeing and pulling back from the field when it comes to working with younger generations?
Yeah, absolutely. So I think a few things, right? Just like all of us, these generations are looking for trust, right? They want advisors who speak their language, who understand them as individuals and as groups. They're looking for more outcome-based planning, right, outside of just traditional risk-based portfolio construction. Different approaches to retirement and financial protection. Many of these folks are staying with employers for less and less time. And so how they navigate even saving for retirement is a great opportunity for all of you versus folks who may have access to a 401k for an extended period. And more education, right? Even outside, around their life journeys, even outside of areas of just traditional investment management. I'll just end with, ask them, right? What are your goals? What are your priorities? What's important to you? Take the time to understand. That really resonates.
Right. So from the advice to the tools, actually, that advisors are using, and they're also interfacing with their clients. That's what you guys specialize in. You're very helpful with that. So what kind of tools do they want? Liz mentioned pictures. It's pictures, but it's a lot more than that. What are you working on, and what are you seeing from their demands?
Well, I think I would kind of echo a few things and maybe thread a thought across all of advice, which is I think you'll also see advice need to be more connected as everyone goes further, because we all have on our phone, I've got an eToro account, I've got a DraftKings, I've got money in a Dunkin' Donuts app. Regardless of your age, you have all of that. So how are those pieces going to thread and come together, and how can you have a better advice outcome where you're really focused on a more intelligent, connected financial life, right? And so when we think about that from a tools perspective to support advisors, a lot of that is grounded in data, and a lot of that is grounded into the way we are threading together for advisors a connected ecosystem. We talk about it from all the data that we have, $5 trillion in spending and $5 trillion in investment assets we have insight into. You then take that and put it on a technology platform, your CRM, your trading, your rebalancing in a client portal, and put those pieces together. Network it to investment solutions, alternatives, and credit exchange, insurance exchange. So it's really about threading the ecosystem behind to deliver that connected advice. And I think all of us in our different areas and different ways that we touch different types of consumers and clients probably need to be thinking about that kind of advice delivery.
So on the client side, what am I actually seeing? Can I see my full ecosystem? Can I see my full sort of health report of my financial picture through a lot of these tools you're working with?
Yeah, because what we'll do is put together your financial plan the financial plan will be connected to the client portal. You can aggregate and bring in all of your other accounts into that. So we've really advanced the way a client can see their full financial life and engage differently, because they need more digital engagement. You need to communicate with them differently. Both at kind of any age has become a much more digital type experience, so they can see that and interact with it a lot differently than the old advisor brings leather-bound book. It's 400 pages. It's your trust and estate plan, and no one ever looks at it.
So we talked about education. That's core. I wish there was a website that just focused on investing education. We talked about tools. We talked about communication. But let's talk about trust, because I think as we look certainly to younger generations, there's a little bit of distrust built up, or they're a little bit skeptical. I have teenage kids. Skepticism is kind of part of the way they live their life. But do they trust financial markets? Do they trust Wall Street, in air quotes? And you do a lot of surveying on this and a lot of communicating. What's your sense?
Yeah, let me tell you, trust is probably the word I've used most this week in conversations that I've had with partners, with advisors, with the people on the stage. Trust is the bedrock of how, investors in general think about, where they invest in, who they invest with. It's the bedrock of all financial decisions. And, we're seeing more and more that younger investors don't trust the system out there. I know crypto is kind of a dirty word or can be kind of a hot topic these days, but there's a reason why it's so big and why younger investors haven't stepped back from it en masse. Caleb, you mentioned this, but we do quarterly surveys at eToro of all kinds of investors, not just on our platform. And the biggest surprise to me has been how steady crypto allocations have been in portfolios. I was looking at the end of Q1, 47% of investors ages 35 to 44 still had crypto in their portfolios. And they invest because they believe believe in decentralization, but they also think that crypto is a transformative asset class. And they're looking for something different. They see that the system is broken. So I'm curious, from an advisor perspective, how y'all are, thinking about approaching this, these investments that mean so much more to the younger generation, that are almost like a signal of, what they think the world can be, instead of, a way to, build wealth, or a way to, achieve that financial independence.
So how is that trust manifesting in the conversations between advisors and clients, especially the younger clients?
Yeah, and look, I would so much rather, when I've had all these great conversations this week, I would rather these clients be hearing from all of you, frankly, with your experience, your expertise, your knowledge of the power of diversification, the power of a plan. And so I think one of the things we're seeing with advisors is more personalized content being put out there, right? Whether it is a short podcast, a video, engaging on social media, getting your presence, your brand, your insights out there in a personalized and consumable way, I think can be incredibly powerful and help clients to get to know you better and have better information, frankly, on what they can do. And then it just comes down to what's common sense but not always common practice, which is asking the questions, listening, letting people share their emotions, even when they're negative emotions, not always just jumping to a conclusion or an answer. I'll just say, for me personally, I've been in the industry 20 years. I know how to invest. I have a financial advisor. Most of the time, we're not talking about my portfolio and performance. I could do that on my own. We're talking about my 2 sons. We're talking about the fact that I'm a primary breadwinner in my family. We're talking about my goals, my dreams, my aspirations. So that's, I live it as well.
Yeah, the
Can I add something real quick to the
please.
trust? So I think the trust piece came out of, it was sort of a baby that was born out of the global financial crisis. There were a lot of, whether you were a younger investor or a seasoned investor, came out of that thinking, I got wronged by the system, right? I didn't know what was in my portfolio. Nobody told me, or people purposely didn't tell me. So then all of these activities and everything that came out of that, everything against Wall Street, I think was just a product of that mistrust. Now, because we're past it, I think there is trust in the financial system as long as investors can feel like they're involved. So there's this DIY aspect. Whether they're working with an advisor or not, there still has to be a lot more closeness to the process and the decision making. Was I involved in that decision? Do I understand why that decision was made? And I think that really changes a lot. And then it's also where they get their information from is different trusted resources, right? We did a survey, 91% of Gen Z investors get their investing information from social media. That would make most of our parents faint, right? I mean, that's terrifying to them, but that's what they trust, and that's okay. But if you want to be in front of them, then you have to be on social platforms, even if it's uncomfortable for you. And I think that's maybe the biggest part to remember.
Well, you guys do a great job of that. I want to come to you in one just second, because I was going to ask you, I think a lot of that was the great financial crisis, but then we had the COVID immediate crash, then we had a recovery. But we've had, and Ben Carlson points this out recently, we've got a lot of kind of bear markets in a short period of time, which is unusual, and the cycles seem to be happening faster. Do you think that trust just gets eroded every time there's a feeling of a correction or a potential bear market, and then there's this scar tissue sensitivity built up?
No, I actually think that now we're conditioned to believe that we should trust monetary policy officials to save us anytime we approach a bear market, right? If you remember what happened in 2018, we got down to, I think, 19.78%, and then it was like, no, it's over, everything's fine, right? I think we've gotten conditioned to that. So the trust might be eroded again if we, at some point, surpass a 30% down, surpass a 40% down. In reality, an average recessionary drawdown is like 44%. So these bear markets that are 20 to 25% are pretty mild by comparison.
They're cute.
They're cute. They're cute.
And I'd love to get your perspective on, kind of what drives it. So when you had the 2000 boom and bust, right? It was an internet driven and everybody was in on it, and stocks.com or pets.com, whatever's in the Super Bowl. And which is different than 2009, which was a bunch of people did a lot of backwards thing and CDOs and all that, and it brought the market down. Does that affect the way y'all think about or the trust in the system? Because those are different type of events, and different kind of recessionary or market declines have different rationales. I'd love to know what you guys think.
Yeah, so I'm so glad we're talking about the great financial crisis when it comes to trust here, because I think that's what set it in motion, which is what you said, Liz. I'll just remind everybody, I'm a younger millennial. I was not in finance, back when the great financial crisis happened. But so many people forget that we had parents who were going through it. I mean, both my parents lost their jobs in the great financial crisis. We certainly weren't immune to what was happening. We knew what was happening, and I think it shaped investor psychology in so many interesting ways. But when it comes to trust too, I think the ensuing bull market, the great bull market of the 2010s, one of the longest in history, was actually something that could have eroded trust as well in millennials and younger investors, because markets seem so unattainable. On one hand, markets are becoming more accessible than ever, but on the other hand, the 2010s were, a decade of everything getting more expensive, and millennials and Gen Zs just trying to, really catch on in a job market that wasn't progressing as quickly as financial markets. So I love when prices go up. Like, I am not saying that, I'm the doomsday bear out here saying that bull markets are bad, but I think we also forget that, as things change, as asset classes change and become have different correlations with other asset classes, you have a new set of investors who are trying to figure out how to step in, and it gets harder and harder.
Right, and even a newer set that's facing now higher interest rates for longer, a different dynamic when we had interest rates floored at zero and there was a lot of free money flowing around. So I'd love to know, you're all sitting on a ton of data across your businesses. I'd love to know what people have been doing across age groups amid sort of the last 3 to 4 years. Do you see a lot of trading? Obviously, 2021 was a little bit abnormal, but did you see a lot of movement across the portfolio, people trying to make adjustments, capture some alpha, or protect themselves even more? Let's start with you and take it on down.
Can I say all of the above?
Yes.
Yeah, so, I mentioned this before, but we've seen investors, especially younger investors, hold on to crypto. There are still healthy allocations to stocks and crypto, although we've seen customers, raise some cash, unsurprisingly, look into bonds, look into, becoming more active with commodities and currencies through different instruments. And interestingly enough, we ask on a quarterly basis, what are you worried about and what are you doing to protect your portfolio from it? And the answer every single quarter, I think except for one around the bank failures in March, the biggest risk was inflation. And people overwhelmingly told us, I'm trying to become more active in my portfolio, which to me tells me how sophisticated investors are. They know that inflation is the hurdle rate, and they feel the pressure to have a portfolio that performs above that. And I know that there are a lot of conversations you can have around that, but investors are becoming more sophisticated, and they see what's happening around them, and they also have the tools at their disposal to fight it. So I don't necessarily hate that. Our typical customer is a long-term investor that has an active portfolio on the side, who's trying to learn more, trying to become more tactical. But we definitely saw an increase in tactical positioning and using options to play a bear market or prices going down or complex views. So investors are becoming more active, but they're also becoming more diversified across ages.
Sophisticated too. So at SoFi, you have obviously the investing in the platforms, but you have a lot of other financial products. You actually started offering different services. Now you're full scale. So not just beyond the investing part of it, but including that as well. What kind of behavior did you see?
Yeah, well, one of the things that we talk about with our members, if they have debt, what is bad debt? What do you do first? Should you be investing if you have bad debt? So the basic concept would be something along the lines of, if you're carrying debt, I don't care what kind of debt it is, credit card debt, car loan, whatever, student loan, and that debt has an interest rate that is above what you can rationally expect on the S&P 500 on an annualized basis, then you pay down that debt first, okay? So you prioritize, let's say you've got a 10% loan out there and you can expect 7% on the S&P, you pay down that 10% loan first. So we start there with what you should prioritize. We have seen people prioritizing paying off credit card debt, which is great because, as we know, credit card debt has ballooned. I don't want to see people building up more. I want to see them paying it down. As far as investing goes, we have an ETF. It's called the SoFi Social 50. It's the 50 most widely held stocks on the platform. So it's a great kind of thumb on the pulse of what they want to own. I'd love to say that when the market rotated in July and cyclicals came back and small caps came back, that our members also bought that stuff. They did not. they still have Apple and Tesla as the top 2 holdings. One thing that did rotate into the top 10, though I don't think it's in there anymore, but it rotated in for a hot second, was Berkshire Hathaway. It was number 10. So Warren Buffett is still cool, apparently, and that made me really happy because before that there were no financials really in that top 10 at all. So they still want the hot stuff. And one of the survey results that surprised me the most, I think, because I'm sure we all remember, talking about these younger generations and saying, oh God, it's going to be their first bear market. It's going to scare them all out of the market. They're never going to invest again. Well, we asked them at the end of last year, what are you going to do now that you've experienced a 25% drawdown in the S&P? You've seen it happen. I think it was 76% of them said they were going to invest just as much or more this year. So it turns out they didn't get that scared, and that was a really encouraging aspect.
Right. Across the tool data, is there anything you can bring to it?
So what we see is, and the easiest thing for a financial advisor to turn to is we see the use of financial planning. Right? Look at the plan, review the plan, because it's a hard conversation when the market goes down 30% and you're debating whether you're going to shift a little bit from emerging markets into growth or value and all those kind of things. But if you're going, let's go back to the financial plan. This is where we were. These are the scenarios that we saw. We can model out these kinds of drops in the market, and the financial advisor sitting with their clients talking about the financial plan and what that probability has or has not changed that dramatically. You can see big drops in the market and not have such a massive impact if you're an advisor who's helping their clients across a broad swatch of things. Your long-term plan is still in effect. You're still in the right loans. You've got the right credit products. You're doing all of those things correctly. Your financial plan looks pretty good, even in a time when the market goes down. So we'll see use of the financial plan, review of the financial plan, and it's a great tool. And I think it's because it's the tool to help settle a client and have them really understand where they are for what they really want to accomplish versus what their investment portfolio is doing right now.
Yeah, it's so important. The plan, small word, but it's so important because once you lose your way, that's the way to get back to it. So what do the advisors report from the field? And how do you counsel them to talk people away from the ledge in times of market uncertainty?
Absolutely. So to answer your first question, just some of the themes we're seeing from some of the top high net worth advisors that we work with across the country, a few things, right? Certainly, tax is becoming, personalization in tax is becoming the cornerstone of a lot of portfolios. And talking about pre-tax returns, in our view, is becoming increasingly irrelevant, right? So thinking about the tax component of the client's portfolio, co-curating portfolios alongside the client and educating them, super important. Alternatives, obviously a growing conversation. I know the rate environment, is one thing to consider, but certainly advisors understand from a diversification and risk management lens and amplifying returns over time, all super important. I think we talked about advisors just understanding the values and convictions of their clients and how that makes its way into investing. More personalization with separately managed accounts. And then, of course, models, right? And to your point about counseling them, your second question, obviously using model portfolios to create more efficiencies, it just frees up time, right? What we're talking about, building trust with clients, requires time, that emotional connection, understanding what matters to them, offering different levels of service. And so ideally, when we think about streamlining our investment process through things like models and other solutions, it helps free up that time to differentiate and be that coach that they need in tough times.
Yeah, so good. Let's talk about expectations for investors up and down the life stage cycle here. Younger investors, do they expect, and I think a lot of us have seen the Gallup polls and a lot of us have seen a lot of that surveying of younger generations don't feel like they're going to have it as good as their parents, or when they think about the best long-term investment, most still think it's going to be real estate over stocks. In terms of expectations, what do you sense from your client base, from your users, and their expectations for returns across their portfolios?
Well, Caleb, I think we're seeing kind of the opposite, and I'll caveat it with, if you ask certain questions, as we do in research, you might get different answers. So there's a little bit of trepidation, but on the whole, we're seeing younger investors feel more confident about their portfolios, about their job situation, about the economy than their older counterparts, which surprises me because, again, look around you. It hasn't been an easy few years, but if you look at the data, the job market has been much more conducive to those younger workers, those low-skilled workers, and that's showing up in confidence, in, again, thoughts on their job situations, thoughts on markets, and, when you boil it down, when people have jobs and they're making money, they're more likely to spend or invest. So we see younger investors feel more confident. They hold on to more risk, unsurprisingly. They still believe in the power of stocks. Of course, they haven't, like I said earlier, they haven't really dumped crypto en masse. But one question that caught my eye in our latest survey that we did at the end of June was, we flat out asked people, we said, do you think we're in a bull market, a period of consistently rising prices? 86% of investors said no. Younger investors felt a little bit better about that. The percentage was around 20 to 30% for investors 44 and younger. But there's a lot of doubt in this market right now. And I think, going back to trust, I think, this says something about how the trust has been broken and how, investors notice that markets aren't acting the same as they have, over the past decade plus. So, on an asset level, younger investors, they still believe in stocks and crypto, but they're also, they're feeling a little nervous as well. Certainly better than the older investors we survey, though.
Right, and with housing affordability sort of so out of line right now, it's hard to see real estate, at least at this point, being a good option. Did you have something, Rich?
I was just going to ask Callie. So, some of that should be kind of time, right? I have time to take risk. I have time to do different things, and I feel a little more oppressed. If you're a Gen Xer and you have you're paying your mother-in-law's long-term care, and your two kids are in college and the third one coming in, and you feel unrest in the market and in the environment and recessionary and all that kind of stuff, you feel that feels a little tighter than I'm 24 or 28 and I've got time to run. Is that would that be?
Oh yeah, for sure. And like risk and allocation questions, I certainly think of that when I see younger investors taking on more risk. Timeframes have a lot to do with it. And one thing I didn't add on, we ask investors about their confidence in the real estate market. Younger investors still feel more confident about real estate than older investors. Totally bucks the narrative that we've heard from other sources throughout this crazy housing market. But just the optimism that we hear from younger investors about the future, about what could happen. They're skeptical, but they also think that change could come. And another thing that I'll say too is that younger investors are more likely, at least according to our research, to invest in things for reasons outside of prices going up. They invest for ownership. Ownership is so hard to find these days, or so hard to acquire. They really value that ownership. They invest for a voice. They're more likely to vote in shareholder meetings. They're more likely to, look at ESG data in, certain stocks and names that they're investing in. So, it's not just a conversation of, how certain assets fit your goals. That is a big bulk of the conversation. I'm not saying it's wrong, but, I think with younger investors, we're going to find more and more that they're going to have these complex feelings around what they're holding and what they're able to do.
Yeah.
Sorry to just add, because we do a lot of research on it too, and it's like 33% of the younger generations want to invest and build companies. So when we think about that from an advisor standpoint, it's a new asset class or a new way to think about financial planning to be able to bring that into the conversation and the equation.
Yeah,
That's awesome.
We talked about issues, things that all investors at all ages care about, but definitely younger investors. I think climate considerations, ESG, SRI, whatever bucket you want to put it in. So what do you see at SoFi? Do you see people making those types of decisions deliberately, seeking options that fit their ethics, that fit where they stand morally?
Yeah, absolutely. We've done surveys. We have an ETF suite. I mentioned the SoFi Social 50. We also have some thematic ETFs, and we've done surveys to try to figure out what kind of themes do you want us to offer you. And socially responsible is always at the top of the list. ESG, environmental stuff is always at the top of the list. It's just a matter of, and this is just kind of an industry-wide thing, there hasn't really been one or a product that has taken off and done it well and outperformed consistently. So it's a tough space to be, but it's very clear that they want thematic investing. So we're trying to figure out what's the best way, what's the best wrapper to offer that to you and give it a level of DIY, like I mentioned before, so that they can feel involved in the process. One of the things that I would add to the real estate conversation is younger investors, I think, have also been conditioned that if you came out of the global financial crisis, they hear these stories all the time, right? Somebody bought one house, flipped it, made a ton of money, used that to flip the next house, made a ton of money, continue on, carry forward, and suddenly you're rich and you're 29 years old, right? Because you just bought houses. And that's just supposed to work forever. And that's not going to work forever. Housing affordability is at the lowest that it's been in a very long time, and they can't afford to finance houses on top of houses on top of houses. That's how we got into the last issue. And there was an article recently about the number of HELOCs, if you all remember what we haven't talked about a HELOC in a long time, but the number of HELOCs that have been taken out recently, because I think that's what people are doing. So there could be a little bit of a rude awakening or a realization that, oh, that doesn't always work. And I do worry about younger investors relying on real estate as a surefire way for making money. And then the other thing that I think we can all be a little sympathetic to them for is, if you're in your 20s or early 30s, you go to a party with other people your age, and you hear these stories about, oh, I wrote a business idea on the back of a napkin, and then I sold it, right, for $200 million when I was 31 years old, and now I have 3 houses and 4 Ferraris and whatever. They hear these stories all the time from people that look like them, that are their same age, and then think to themselves, well, oh my God, what am I doing wrong, right? Why haven't I sold a company for $200 million? I'm an idiot, right? So I think there's a little bit of sympathy and a lot more competition that they have amongst themselves, and it makes them hungrier. And as professional investors, you know that when you're hungry for a return, what do? You take too much risk to try to get it, right? So a lot of their behavior, I think, can be explained by just the era that they're living in and what their peer group looks like.
And they also don't have to go to that cocktail party to see that. They just go to TikTok and no one knows what the outcome of it is. I flipped 4 houses. Look here's my Ferrari and all that. And then 2 months later, they might not have anything, but they're trained and engaged in that conversation.
Right. Is looking at immediate returns or immediate disaster. I think that's when you see what young people look at. It's people watching other people play video games or watching other people explain things. Immediate payoff. This big whole gambling thing where people make huge bets on live, Twitch, and watch whether you bust or you double your money. That's become very popular. But so, given the range of issues now that investors of all ages, but certainly the younger demographics, are bringing to their investment considerations, what does that mean for the advisor in terms of offerings in the menu? Like, what do they have to bring to the table right now?
Yeah, absolutely. So again, what we're seeing from a lot of the advisors that we work with are a few things. One, they're recognizing where the wealth is heading, right? So we talk about the great wealth transfer and the trillions of dollars of assets coming to this generation, but in reality, their income levels, for all the reasons we're talking about, are also absolutely on the rise. And so thinking now about how they can support some of these quote unquote smaller accounts to grow alongside them. So whether that's, again, managed models, robo-advice, structuring their team thoughtfully to have more junior advisors facing off directly with these clients to make those connections are some of the things. Doing well by doing good, right? More and more advisors are getting out in their communities, having financial literacy discussions with a lot of these groups. It builds brand, it builds loyalty, it builds pipeline, and then talk about how you're giving back. I would also say just preparing for success, right? Many are, yes, holding themselves out as those financial coaches. They're also embracing technology in new ways, but they're partnering with third-party experts in different ways. They're getting creative. So CPAs and attorneys, obviously very important. But what about the business consultants? We talk about how a lot of these clients have a side gig, a side hustle, part of the gig economy, website designers. There's a lot of unique experts out there that advisors are partnering with to get access to and to meet some of these clients. So those are some ideas.
Right. So let's take it up the ladder a little bit to my generation, 50s, in terms of our expectations, in terms of building the right sort of portfolio and protection. Just from my own perspective, those are the things that I worry about. Insurance, like I feel like my advisor and their team has the portfolio under control, but insurance, long-term care, planning for my kids, estate planning, right? The mix gets more and more complicated as we get older. So in terms of both tools and advice that advisors are giving, as things get more complex for older generations, how are they having to adapt?
So I'll start. I mean, I think it goes back a little bit to what I was saying, the connected financial life that we all want, because I've got all these things and they're pretty complex, and I've got them for, a generation has them for not only for themselves, but their parents, their children. They're putting these things together, so you need the technology and tools to help thread that all together, right? And so that's how we think about it, is what can we deliver for financial advisors from the data to the planning to the platform it sits on to be able to offer more of that, give advisors more time to serve their clients, engage with them is critical, and everything Liz just said is super important. So the issues that you have as you get older, I don't even know if it's fair to call them more complex, because if I'm 24, I've got these things in front of me. That's hard and it's complex, and I want those to work well. And if I'm 55, I want these things to work well together. So I really think it's about, for us, it's just putting the pieces in place and the tools that allow you to go from the different experiences also that you will want as you age in that sophistication of or complexity of things that you have. You know, it's personalization isn't just portfolios, it's the way you deliver advice as a financial advisor, because, you know, some want the old leather-bound book and they want a quarterly review and they want to do it face-to-face if you're 55, and I'm 55 and I don't ever really need to see a financial, I have one, great one, I don't ever need to see him in person again. It's just not essential to me. I want to be able to take my financial plan, toggle it on a digital experience and see what, if I could retire a year earlier, what would that do to the outcome? And not have to call my financial advisor and run the financial plan again, all those kind of things. So everything will be about, and others will look much differently, everything will be about a hybrid digital engaged experience for advisors where they can actually just really personalize and individualize the experience for their clients for all that complexity.
Yeah. I think the data is showing stress levels are high for all the reasons you said. You know, oftentimes this could be the sandwich generation. You're worried about kids. You're thinking about insurance, right? Thinking about, am I going to have enough to retire? And inflation certainly not helping right now. So I think, you know, a few things. So yes, expectations are higher across the board for clients with their advisors, right? But the good news is I also think clients don't expect advisors any longer to have all the answers. So building that network of experts I mentioned in the areas you just described, I think is really critical. The other thing we tell advisors, again, is make sure you're telling your clients all that you offer in your business. Don't leave it up to them to ask you. That's not their job, right? Lay it out, even if it's on a sheet of paper, all the services that you or your partners can offer, so they know they can come to you for all of these different demands. And just the last thing, and this is a thank you as well, the role you play as that accountability partner, that behavioral coach, especially when emotions are running wild, is so critical. Please don't underestimate it. By the way, we at BlackRock have a whole behavioral finance program we call the Psychology of Investing, with a lot of end client approved resources and content right on our advisor center to support you, because those conversations, keeping people calm, invested, and keeping their emotions out of the equation is probably the single most important thing that we can do, especially now.
I was going to ask you, how are advisors doing? You say investors are stressed, clients are stressed, advisors are people too. You all doing okay out there? But how are they doing? How are they telling you?
We got some thumbs up. Yeah, look, we need to support them too. Just like your clients are expecting more from you, you should expect more from your partners, including asset managers like us and all of us here, right? To give you the resources, the support for your business, for your clients. It's a tough time. There's a lot of uncertainty with rates. S&P is up. Where is it going? How do I talk to my clients? They're stressed. So I think just like you're expected more, expect more of your partners. Demand more of your partners to support you too.
Great. All right, let's get a little bit tactical. I'm going to rely on both of you here. Let's say, we'll start with you. I'm 30. I'm a young professional, kind of making close to six figures, maybe starting a family. Help me build a model portfolio. You don't have to pick stocks for me. But what do you think is the kind of portfolio that would make me feel like my wealth is going to grow, and these are assets I can believe in over the long term?
Yeah, I'm going to give you a really bad answer for this. I'm going to ask you for your why and your goals. And you gave me a little bit there.
Yeah,
but
I want to be able to grow my money over time, potentially buy an asset like a house, but certainly put away enough for retirement, but feel like I'm doing the right thing in terms of building my wealth while I pursue my career.
Okay, gotcha. Love the details.
I'm in good health, and I'm happily married.
Cool, you're easy. All right, so I'd start with, again, dig a little bit deeper on the goals. You want to build wealth, but how exactly do you want to get there? Where do you see these milestones in your life happening? When do you want to buy that house? 5 years down the road? Do you see yourself starting a family, 5 to 6 years down the road? And I know that these are questions that financial advisors ask. Certainly I'm approaching it in a similar way, but I think really digging into the why is so important when we have this younger generation of investors that we're all struggling to understand. You would not believe what some people come to me and say when I ask them about their why, or why they're investing, basically. We had a customer event actually last night with some of our high equity customers here in the LA area, and many of them started talking to me about how they started investing because their friends started investing, which doesn't surprise me at all. Investors value community. I mean, we live in the social media generation where, I can, on eToro's platform, I can see what other people are investing in, but, the conversation around money and investing is more prominent than ever. So, really dig into their why to understand exactly, why they're holding certain things. I mean, is there an ownership component there? Is there, an ethics or a moral component there? But, if I'm going down to asset allocation, I mean, I don't think you can rule out the stock market. I do a lot of research on market history, and I call the stock market call on human ingenuity. I mean, humans were a smart race, right? And it's, everything we go through in society, there's just so much data to show that we eventually overcome it. So to build wealth, you still need to look at stocks. I think it's smart to consider what a decentralized future could look like. And many younger investors are already considering that. And I'm not saying go all in on crypto. Let's be realistic. But, just think about the way that the world is changing. Think, look at the ways that society is becoming decentralized around you. If you're considering crypto, think about, the reasons why you'd want to own it and how you'd manage it, set your targets. And then, for their shorter term goals, you can't overlook bonds and cash. And, rates are especially attractive right now.
Right. So a lot of the same things, but in terms of how you allocate that is really where you are and where you want to go. So take me up the age ladder a little bit, Liz, if you could, to 45 to 50, family, maybe own a home, have a mortgage, maybe some debt, maybe some leftover student loan debt, and a dual income family, 150 grand-ish. My expectations, I'll be in the market 30, 40 odd years. How should I build a portfolio around that?
Well, I mean, 30 to 40 years is a long time, right? So I don't know that I would give you that different of an answer of if you were 30, honestly. But if you started today, if you hadn't invested at all, I'm going to be a little more market timey about this because I think we're late in the economic cycle, which is when large caps usually do well, and large caps have outperformed small caps this year by 13 to 14%. So obviously they've done pretty well. So I always think of it like a hub and spoke, right? And the hub should usually be something that you don't have to worry about. You want exposure, you want beta exposure, so that when the market goes up, you go up. In that hub, this is the other thing. Don't just buy ETFs blindly. Just because it has the most assets in it doesn't mean that it's the best ETF, right? So if you want just S&P exposure, find the cheapest S&P exposure that you can. And right now, honestly, I'd split that center of half market cap weighted S&P and half equal weighted S&P, because some of the stuff that's smaller is a lot cheaper than some of the stuff that's bigger. And if there is a rotation out of big into small, you want to be there for that as well. And then this is where it gets really sexy. The spokes, at this point in the cycle, gold, treasuries, utilities, right? Energy, that kind of stuff that you're like, oh my God, I got to convince a client to buy more treasuries or a money market fund. Get paid while you wait. We have to wait for a while. We don't know when this is going to end. I agree it has taken much, much longer than any of us thought. I don't think this time is that much different. So you don't want to be all in on the risky stuff, assuming that we are early cycle in an expansion, only to find out that all of the signs that we are late cycle were there. So get paid while you wait, and those spokes are the pieces that you can be more tactical on. Obviously, be smart about it with taxes, but again, don't buy ETFs blindly. Make sure that you're doing some research about what you're putting that money in.
Yeah,
Great advice.
Can I tap in one more on the tactical side, because I completely ignored that part of the question. I mean, if we're thinking about over the next year, obviously nobody has a crystal ball, but I mean, rates are quite high right now, and given all the pressure we're seeing on the economy, it's hard to see them going much higher. I mean, who knows what will happen? But I mean, the Fed desperately wants to get inflation down, and now we're seeing higher oil prices. We're seeing a higher dollar. There are just so many pressure valves that are working on the economy right now. So tactically, we've been telling our customers to remember that rates go up and down, and there's a greater chance that they're probably going to go down more. So don't forget your rate-sensitive sectors. Think about quality risk. Think about companies that can be self-funded, that are profitable, but also, again, consider your long-term goals. We're speaking to younger customers. If you have to be tactical between now and a year from now to stay in the markets, then go ahead and do it. I mean, we understand that you're a complex human being here with, your own personal situation in front of you. So, we've been one of the more optimistic firms. We still think the Fed can pull this off. We like the fact that inflation has progressed so much, and we think that can support the market. But you remember to hold on to your rate-sensitive sectors, and don't roll out the chances of a recession.
Yeah. So the two things you guys both brought up: cycles, sector rotation, where we are, how this plays out in different time periods. That's super important. That gives you that timing perspective that I think, especially newer clients, don't necessarily have when they start investing. So let's talk about it from the advisor's role in terms of opening that up and saying these have patterns. This is how these things usually work. How important is that market knowledge? And then explaining it clearly, charts, whatever works.
Yeah. So one of the programs that BlackRock creates is called Student of the Markets, and it's a monthly piece that we create. We update it every month with key themes that are happening today. The reason I bring it up, it is end investor approved, very visual in nature, easy to consume, but it helps put markets in historical perspective. And I think that's why it's such a popular piece for folks who haven't lived through so many cycles and experiences of how do we take a step back, look at what's happened through history, look at what's happened through time, and kind of level set. And so I think those, to your point, end client friendly visual pieces that put things in perspective can't be leveraged enough. So that's just one example I would share.
On the tool side, what does that look like?
I was actually, sorry, my head was spinning to a different place, but answering the question is that...
You were allocating your portfolio in your mind,
Yeah.
making some changes based upon Liz's knowledge.
In 1996 to 2002, I worked very closely with the great fund manager, Peter Lynch at Fidelity, and worked closely with him and wrote for him and did a bunch of things. And I just thought about, as we've been discussing this, there's all these cycles. It's a little bit, there's what's old is new again, or what's new is old again, whatever that phrase is. I mean, there's different reasons, and it feels different at every time, and it feels a little different for each generation to a degree. But, it wasn't a great time to be a recession in 1991 to be coming out of school and looking for a job, and it's not been a good, as somebody just said, it's not been a good years now, right? So that younger investor saw that. They saw their parents, some lose jobs in that recession and all that kind of stuff. So I was just thinking that through. Sorry, Callie, I wasn't answering your question on the tool side, but it's just about being prepared, being knowledgeable, and being in a position to help your clients understand that. And again, I always think about it from the tools perspective. It's all about we're focused on making it easier for the financial advisor to individualize that conversation and that entire portfolio, not an investment portfolio, your financial portfolio, through the financial plan, through data to kind of really answer the why of anyone who's investing or any client you're working with.
Let's go out on this, plus our bonus question. But what's missing from the conversation around investing and planning, I should say, for different generations? What are we not talking enough about? You guys have a second to think about that. And if anybody wants to take this question, is there a place for corporate trust services with today's younger investors? Anybody have an answer on that? All right, what's missing from the conversation?
I think continuing to make it a family conversation, whether you're talking about health and wealth with, parents' generation, whether you're talking about relationships with money, grandchildren, planning HSAs, there's all kinds of things. I think the more we can make it more of a family conversation, I think it helps you engage, and I think it helps that family as well.
I think it's all about speed. I mean, the world moves for certain. I just made a point, it's kind of the cycles come and go. They go faster. It gets communicated more quickly. And so for us, for providing tools for financial advisors, and you said you should all push us to do more, be better, it's getting the tools out and adding new components, right? We have crypto, and you're pointing out how important that is as an asset class. You don't see a tremendous, not the same degree of adoption for financial advisors, but we need to, what's the next crypto? What are the next things that have to be put into that overall financial plan and into a portfolio construction?
My mic canceled me for talking about gold and
Yeah.
utilities. I think that the amount of information that's available to younger investors is great. It's a huge benefit. What we don't tell them enough is that just because information is there doesn't mean you have to do something about it. You don't have to trade on it. You don't have to act. Just read it. Just consume it and then internalize it. You don't have to act on it every single time.
Great point.
Yeah, man, I love that answer. I'm gonna say AI, but I'm gonna take a different twist on it. Learning about how to trust yourself and when to, step in and get that third party or that, potential robo-advisor type help with your portfolio. It all boils down to trust, right? But another thing that we see with our customers is, the questions around what are my goals versus what is everybody else's goal, and how is the line blurring for me? So I think AI makes it even more complicated. In fact, we did a survey on if investors would use AI for their portfolios, and one of the main reasons why investors said they'd consider it is because they don't trust themselves to invest, which breaks my heart, but it also doesn't surprise me at all. So, your goals versus everybody else's goals and how AI and LLMs fit into that.
Yeah. You mentioned Trust, and I didn't mention my favorite album, but I'd probably have to say Trust by Elvis Costello. So thank you for that. Let's finish with this, and then we'll head out. The movie that best defines you and your generation. Let's take it down the line.
All right, I gotta say Harry Potter, because every younger millennial has seen Harry Potter. Like, come on. Woo! Love it. But okay, on a serious note, I'm gonna say The Big Short, just going back to the Great Financial Crisis. I think the Great Financial Crisis defined millennial and Gen Z psychology more than people know.
Great answer.
I'm going to go with Scream. A lot of my generation graduated into the Great Financial Crisis, terrifying. And then as they were approaching 40, a pandemic came and ripped through all of the world's population, also terrifying. So it's been a big horror movie.
Jaws. We're going to need a bigger boat.
I'm going to say Goonies, because we don't give up and we don't accept the fate that is given to us.
Great picks. Put those on your watch list, folks. Callie Cox, Liz Young, Rich Aneser, and Liz Koehler. Thank you so much. Thank you, Future Proof. Thank you, Advisor Circle.